Welcome. In this explainer, we're going to break down a process that is really the engine of business finance, the accounting cycle. Think of it as the system that keeps a company's financial records running smoothly and, telling the right story.
And let's be real for a second. If you've ever stared at a spreadsheet just packed with numbers and felt, a little lost, you are definitely not alone. Even our source for this, Investopedia, says it right there. Bookkeeping can feel pretty darn daunting.
But what if there was a roadmap for all that financial data? A simple, repeatable process that's designed specifically to bring order to the chaos and, create a clear path through all those numbers.
All right, so here's how we're going to tackle this. First, we'll talk about why this cycle is so important for getting clarity. Then, we'll dive into the three main phases: recording everything correctly, making sure it's all accurate, and finally, turning that data into a financial story. So, what is this cycle really? Well, it's not just some random to-do list. It's a powerful 8-step system with one big goal: to bring clarity to your finances. The accounting cycle is basically a loop. It's a continuous, repeatable process that walks you through every essential step, from the second a transaction happens all the way to that final report. It's a whole system built to guarantee accuracy, period after period.
And the really powerful thing about this cycle is just how versatile it is. It really doesn't matter if you're a tiny local shop or a huge multinational corporation. It works with modern software, you can adapt it for different accounting methods, and you can run it monthly, quarterly, or annually. It's really built to fit your business.
Okay, let's jump into the very first phase of the cycle. This part is the foundation for everything that comes after. It's all about capturing the financial reality of your business, one transaction at a time.
So this first phase is all about getting the raw data, what actually happened in your business, into the system. It really boils down to 3 key actions. You identify it, you record it, and then you post it.
Step 1 sounds almost too simple, but it's the bedrock of this entire process. You have to identify every single financial event. Every sale, every purchase, every payment. If money or value changed hands, it has to be accounted for. Now this highlights a really critical choice in accounting. When do you actually record a transaction? With the cash method, it's easy. You just record it when cash physically changes hands. But most businesses, they use the accrual method. That means you record revenue when you've earned it, even if you haven't been paid yet. And that, right there, gives you a much, much truer picture of your business's health over time.
So once you've recorded a transaction in your journal, the next step is to post it to the general ledger. You can think of the general ledger as kind of like the master filing cabinet, where every single transaction gets sorted into its own specific folder, like sales, rent, or office supplies.
Okay, so we've got all our transactions in the system. Now we can move on to phase 2, which is all about quality control. It's about making sure everything is 100% accurate.
And this kind of begs the question, right? If you have potentially thousands and thousands of entries, how in the world can you check for mistakes efficiently without having to go through it line by painful line?
Well, the answer is this really clever tool called a trial balance. This is basically a master worksheet. It pulls the final balance from every single account in your general ledger and puts it all in one place.
And this slide here shows you exactly how it works. Now, don't get bogged down in the words debits and credits. A simple way to think about it is that every transaction has 2 sides. So here, you just list all the debit balances in one column and all the credit balances in the other. Then you just add them up.
And that brings us to the absolute golden rule of accounting. Those 2 columns have to balance perfectly. If the totals match, hey, you get the green light. But if they're not equal, that's an immediate red flag. It tells you there is a mistake somewhere in your books that you have to go find.
So that leads us right into the next 2 steps: analyzing and adjusting. First, you hunt for any errors. Then, you make what are called adjusting entries. Now, these are special entries that don't just fix mistakes, they also help you account for tricky things, like a yearly insurance payment, or maybe a project you finished but you haven't actually been paid for yet.
So once all the data's in, it's been balanced, it's been adjusted, we get to the most important part. This is where all that hard work finally pays off. This is where the numbers get turned into the financial story of your business.
And that story is told through 3 key financial statements. And believe me, these aren't just for accountants. These are the exact reports that investors, banks, and business owners all rely on to make huge decisions.
First up, we've got the balance sheet. The best way to think about this is like a financial photograph. It captures one single moment in time and gives you a snapshot of what your company owns, those are its assets, versus what it owes, its liabilities.
Next up is the income statement. You might have heard this called the P&L, for profit and loss. If the balance sheet was a photo, this is more like a movie. It shows your performance over a stretch of time, say a month or a quarter, and it answers the big question, did we make money or not?
And finally, the cash flow statement. This one is so critical because, profit on paper doesn't always mean cash in the bank. This statement tracks the actual cash moving in and out of your business. It tells you if you actually have enough cash on hand to pay your bills, pay your people, and grow.
So, our financial story has been told through those reports. There's just one last thing to do to complete the cycle and get everything ready for the next period.
This final step, closing the books, basically finalizes all the reports for the period and it resets certain accounts back to zero. This gives you a totally clean slate for the next month or quarter, which is what makes this a true continuous cycle.
So what's the big takeaway here? The accounting cycle isn't just a chore for bookkeepers. It's a really powerful system for turning financial chaos into genuine clarity and confidence. It gives you the real info you need to make smarter decisions. So I guess the question to leave you with is this: what part of your financial world could use a little more clarity?